All right, folks, it is time to unpack the big one, taxes. My name is Kent, and this is your half-hour call.
Attention cast and crew, this is your half-hour call. Half hour to the top of the show. Half hour.
What's up, friends? It is time for part 3 of Let's Talk About Money, giving you a jumpstart on becoming a financially healthy stage manager. We've earned our money, we've budgeted accordingly, and now it is time to pay the piper, or in this case, Uncle Sam. It's time to talk about taxes. And make sure you stick around till the end of the video where I will give you my top 3 tax traps that stage managers fall into. But if this is your first time here, welcome. My name is Kent, and you are watching Half Hour Call. Half Hour Call is dedicated to shining the spotlight on technical theater, so if you want how-to videos, interviews with industry leaders, or general theater updates, make sure you hit that subscribe button and notification bell so you don't miss another video. Nobody enjoys paying taxes, but pretending like they don't exist until April can mean you actually end up paying more taxes and fees than you really need to. Not only do tax codes and laws change frequently, but as freelancers, our tax situation can be wildly different from year to year, so it's always a good idea to get help from an accountant or a software like TurboTax, not a sponsor, to make sure that you file your taxes correctly. Before we get too far into it, this is not a video on how to do your taxes step by step. This is just a compilation of research that I've done paired with my personal experiences as a freelance stage manager. You should always seek advice from a qualified professional, which again, I am not. Taxes are a not at all fun game where the government knows exactly how much you owe them, but you also have to guess that same number, and if you get the number wrong, you can get in a lot of trouble. So it's all the more reason to understand exactly what the heck is going on from the very beginning. Let's dive right in. So before you can pay taxes on money, you have to earn the money. And for stage managers, this falls into generally 2 categories: employee income and independent contractor income. Most of the time, stage managers should not be classified as independent contractors, and the employers that are misclassifying us are doing so illegally, taking advantage of artists, and risking major penalties from the IRS if they find out about it. For more on this and why it's a bad thing, check out this video right here. But the fact is, it's a thing that happens a lot, and it's probably not going away anytime soon. So you need to know exactly what you're signing up for when you agree to do a gig. Whenever you start a new job, your employer should be having you fill out a tax document to collect your information to give to the employer. For employee work, this will be a W-4, and for independent contractor work, this will be a W-9. Then at the end of the year, your tax information from the employer is given to you on a document. For employees, it's given to you on a W-2, and for independent contractors, it is given to you on a 1099. In years past, you may have been given a 1099 MISC or miscellaneous for independent contractor work, but as of this year, there is a new document called the 1099 NEC, which stands for non-employee compensation and should be what your employers are giving you for independent contractor work. There are a bunch of 1099 documents, but the ones that you are most likely to run into in your career as a stage manager are the 1099 NEC, 1099 MISC, 1099G, which stands for government and is what you'll get for unemployment or tax refunds, 1099 INT, which is interest from savings account or investments, 1099 DIV, which is dividends from certain types of investments, 1099R, which stands for retirement, and depending on how or if student loans are canceled, you may need to worry about the 1099C, which stands for canceled debt. This year, I have a 1099 NEC, a 1099 MISC, a 1099G, a 1099 INT, and a 1099 DIV, and TurboTax Self-Employed, not a sponsor, is handling all of that easily. Currently, as an independent contractor, you can itemize business expenses for your 1099 income. But as a W-2 employee, you cannot currently itemize business expenses for your W-2 income. You used to be able to do this for both kinds of income, but former President Trump changed the rule in 2018. President Biden may change the rule yet again, but for 2020, the rule remains. However, the biggest difference between being a W-2 employee and being a 1099 independent contractor is how the taxes are actually paid. When you work as an employee, your employer withholds money from your income and pays quarterly taxes on your behalf. The employer also pays out of their pocket half of your FICA contributions, which is the Federal Insurance Contributions Act, or Medicare and Social Security. But when you're an independent contractor, you are both the employee and the employer, so all of that tax responsibility falls to you. Let's say Mark the stage manager made $30,000 exactly in 2020. He worked as an employee at a regional theater. Roger, the stage manager, also made $30,000 exactly in 2020, but he worked as an independent contractor for a company that hosts events. They're both single with no children and both live in a state without state income tax like Florida. Mark's company takes 9.82%, or $2,946, out of his paycheck for taxes, and 7.65%, or $2,295, out for Social Security and Medicare FICA contributions. So his total take-home pay is $24,759. Roger's company doesn't take anything out, so his take-home pay is still $30,000. They both take the standard deduction and have the same taxable income, which means they have to pay the same federal income tax of $1,914.50. For Mark, his FICA contributions are only 7.65%, or $1,346.40, while Roger's are 15.3%, or $2,692.80. This is because Mark's employer contributed the other half of this amount. But since Roger is technically his own employer, he has to shell out for both. This means that come tax time, Mark will get a refund of $1,980.10, while Roger will owe $4,607.30. Since less than 40% of Americans can afford a $1,000 emergency, if Roger didn't specifically set aside money for taxes, he may have to put that on a credit card that would rack up $2,000 in interest and take up to 10 years to pay off. Roger could have changed his fate in 3 ways. Roger's biggest mistake was not hitting the like button for the YouTube algorithm. First, he could have set aside some money for taxes, preferably in a high-yield savings account so you can earn a little bit of interest throughout the year. The general rule of thumb is to save 25 to 30% of your self-employed income for Uncle Sam. Second, he could have paid estimated quarterly taxes. Not only would this reduce the lump sum at the end of the year, but in our example, Roger very well may have been penalized for failing to pay enough estimated quarterly taxes. According to the IRS, you need to pay estimated quarterly income tax if you anticipate owing $1,000 or more in income tax on your self-employed work. Third, he could have itemized business expenses to reduce his taxable income. One benefit of self-employed work is the ability to write off business expenses. The IRS says that in order to be deductible, a business expense must be ordinary and necessary. An ordinary business expense is one that is common and accepted in your trade, and a necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. For an artistic field like stage management, this can sometimes be a little tricky to determine. My personal rule of thumb is that I have to be prepared to explain to an auditor why that expense is ordinary and necessary. Things that I have written off include vehicle expenses. You can either itemize the actual costs of using your vehicle for work, including gas, repairs, and depreciation, or you can track your business miles, which does not include your daily commute, and use the federal mileage deduction to estimate it that way. Currently, the federal mileage deduction is about 57 cents per mile.
So that's a write-off.
Office supplies. You're welcome, stage managers.
Those are a write-off.
Business-related travel, including transportation costs and the federal per diem for the location that you're traveling to. Link in the description below.
That's a write-off?
Technology that is used for work, such as laptops or iPads.
You write it off.
One I added this year is a Zoom subscription.
I can just write that off?
Costs for training, classes, and certifications.
So that's a write-off.
Research costs, including books, scripts, and even tickets to shows.
That's a write-off?
Website hosting fees.
You write it off.
And Stage Manager Ducks, 25% off through the end of February only, available at kentjamescollins.com/store.
That's not a write-off!
Okay, maybe not that last one, but the rest of them are. Down in the description below, there is a link to the IRS webpage that talks about business expenses in more detail. There's a lot of jargon and it's not super relevant to our work as stage managers, so when in doubt, talk to a professional. Add up your expenses and your tax preparer or software will deduct it from your self-employed income, lowering your total taxable income. Even if you currently don't have self-employed income lined up, it can be a good idea to keep track of these expenses anyway, and make sure you keep your receipts. Well, that's all fine and dandy for people who have 1099 income, but what about the people who have W-2 income? Well, there are a few types of deductions that work no matter what kind of income you have. The most common deduction is the standard deduction. You can either choose to take the standard deduction or itemize certain personal expenses. These itemized personal expenses are things like medical expenses, mortgage interest, charitable donations, and state and local taxes. These are considered below-the-line deductions. And if these below-the-line deductions add up to less than the standard deduction, which for this year is $12,400, it's probably best to take the standard deduction. There are also above-the-line deductions, which can happen in addition to your itemized expenses or the standard deduction. Some above-the-line deductions that you might run into could include student loan interest, contributions to certain retirement accounts, and contributions to health savings accounts. In addition to deductions, you may also be able to lower your taxes with credits. Deductions are applied to your taxable income, while credits are applied to the actual taxes that you owe. So a $1,000 deduction may only lower your taxes by $120, while a $1,000 tax credit is going to lower your taxes by $1,000. Some tax credits are even refundable, meaning that it could increase your tax refund. Perhaps the most common tax credit is the credit for children and other dependents. And then this year, a very common tax credit is going to be the recovery rebate credit. If you are like me and you did not get your stimulus check because you were claimed as a dependent in 2018, but you're not being claimed as a dependent in 2020, you can qualify for a recovery rebate credit where you'll get the full amount of both stimulus checks refunded on your taxes. Links to details from the IRS in the description below. Unlike Mark and Roger, a lot of stage managers have both W-2 and 1099 income throughout a year. This means that come tax time, some of your employers will have withheld taxes for you and others will not. If you are anticipating having a blended income that is pretty well balanced between 1099 and W-2 income, or leans more heavily towards W-2 income, your employers may have withheld enough taxes to cover your self-employment tax. When I fill out my W-4, which is the document that you give to employers, I have them withhold the maximum amount of taxes from my paycheck. So this way I am less likely to owe estimated quarterly taxes. I personally would never try to do taxes completely by myself. I have enough knowledge to know what I need to keep track of and how to use the software that I use, but when it comes to actually executing that and using the government documents, no thank you. I use TurboTax, and there have been years where I've been able to do my entire taxes from my phone. You can also use qualified accountants or tax preparers, and some even specialize in all the idiosyncrasies of theater artists. Some even are theater artists who do tax preparation as a side gig. Pro tip, a lot of human tax preparers and accountants charge by the hour, so the more thorough you are with your preparation, the more money you'll save. Speaking of preparing your documentation, all of my tax information is right here in this 5-folder organizer. Since I travel for work, keeping my records small and portable is super important, but I've had one too many computers die on me to trust a digital copy alone. The general rule is to keep the last 3 years of tax records in case you get audited, but since stage managers have such weird taxes and I have so much self-employed nonsense going on, and since this already has 5 folders anyway, I go ahead and keep 5 years worth. At the start of each year, I put 2 envelopes in each year. One is labeled expenses and one is labeled income. As I work each job I work or each tax document I expect to receive at the end of the year, I write it on the front of that envelope. So that way at the end of the year, as I receive tax documents, I can just check them off one by one and make sure that I'm not missing a tax document before I submit my taxes. The expenses envelope is where I keep my receipts. At the top of the receipt, I write what it was for, then I put it in the envelope. For online purchases, I print out the invoice and fold it up and slip it in the envelope just like a receipt. Then at the end of the year, I pull all of them out, sort them in the different categories that TurboTax allows me to deduct, add them all up, and then store them in the envelope sorted. I'll have a few extra envelopes because I like to keep my expenses for theater work and my expenses for my small business of half-hour call separate, but the system is the same. All right, friends, I know that was a lot of information, but it is time for the top 3 tax traps that you want to avoid. Number 1, and I cannot say this enough, set aside money for taxes on your independent contractor work. A nasty surprise at the end of the year is never a welcome sight. Number 2, you may owe income tax in multiple states. Any state that you lived in or any state that you worked in could require you to file income tax for that state. And if you're on tour, you may actually have to file income tax in every state that tour performs in. Since TurboTax charges you by the state for each state that you file, if you're on a tour like that, you may actually save money by going through an accountant or a tax preparer instead of having to pay, I think it's $40 for every single state. And number 3, especially relevant this year, unemployment assistance is taxable. When you apply for your unemployment benefits, you can opt in to have taxes removed from your paycheck. I know this is the first time that a lot of people, including myself, have gotten unemployment benefits, and certainly the first year that they've been as large sums as they have been. So this is your warning now that you very well may owe taxes on that money. Be sure to check out all of the links and resources in the description below, and don't forget to tax the like button by turning it blue. Thank you so much for watching, liking, commenting, and subscribing. I hope you enjoyed this video. My name is Kent, and this has been your half-hour call.
This snazzy feathered production assistant, as well as other cool stage management merchandise, is now available at kentjamescollins.com/store. Link in the description below.